So thanks again for joining us at the Real Deal Showcase and Forum. We appreciate that you decided to stay through until the bitter end. We'll try to make it as interesting as possible. So I am Conrad Putzier. I'm one of the reporters at The Real Deal, and the title of this panel is Changing Commercial, looking at the shifting strategies of commercial brokers and brokerages amid a slowing market. And we have a pretty interesting, pretty diverse group of panelists here. On my left is Joanne Podell. She's an executive vice chair at Cushman & Wakefield and one of the top retail brokers in the city. She's been with the company since about 2001, joined them from Newmark, and she's done so many deals that I'm not going to go through all of them, but maybe just to mention one. She brokered the Nike retail lease at 650 Fifth Avenue, which I believe was the most expensive, or one of the most expensive deals, retail deals in the city's history.
Is that a question?
No. And then to her left is, of course, Peter Ragwadi, who is the tri-state chairman of JLL. He's been with the brokerage since 2002. And apart from heading JLL's operations in Connecticut, New Jersey, and New York, he's also a very accomplished office leasing broker, and his big deals include Bank of America's move to One Bryant Park, and more recently, BlackRock's move to Hudson Yards. And then last but not least, we have Dustin Stoli. He's sort of the debt faction on the panel. He is vice chair and co-head of Newmark Knight Frank's Debt and Structured Finance Group. He joined Newmark last summer from JLL, where he'd been for almost a decade, so I'm sure Peter and Dustin know each other pretty well. I hope there's no hard feelings. Yeah, and he has reportedly, I don't know who reported this, probably us, done more than 30 billion in loan deals over his career. So we have retail, we have office, we have debt. We're going to talk about the general state of the brokerage business. And I'm going to start off with a topic that's been pretty big recently, which is IPOs. So it used to be two big public brokerage firms, CBRE and Cushman & Wakefield, and then a bunch of private companies, some bigger, some smaller, but that was really it. And then in December, Newmark Knight Frank went public. So now it's three. Cushman & Wakefield reportedly is also working towards an IPO. So we could be going from two big public brokerages to four public brokerages. And I want to talk a bit about what this does in terms of how it changes the industry. And Dustin, maybe we'll just start off with a very banal question. You know, you joined Newmark when it was a private company, and then one day, suddenly it's a public company. Did anything change for you from one day to the next?
I mean, I joined Newmark in July, as you mentioned, after 10 years of having the pleasure of working with Peter at JLL. But I obviously knew the company was going to go public when I joined, and that was an important part of my consideration. I report right to our CEO, Barry Gossin. And I can honestly tell you, it really hasn't changed my day-to-day at all. I mean, from an accounting perspective, obviously it becomes a little bit more complicated, but the company is extraordinarily well capitalized. I think it may be the only major commercial brokerage firm where the employees own roughly 30% of the business, so that sort of changes the dynamic of how folks work together and work towards a common goal. And so for me, I went in eyes wide open. Barry hasn't changed. The firm hasn't changed. It's been good.
Peter, you've obviously you're at a company that's been public for quite a while. Is there ever a day where you wish you were at a private company, where you didn't have that scrutiny of a public company? Does it change the way you working at a public company as opposed to a private company?
Well, obviously, the demands being public around transparency, around earnings, put a lot of pressure on the business. You know, last year we had a record year in the tri-state region, and the reward for being public was we needed to do 15% better this year. So that sometimes is the challenge. But being a part of a company that has been public for so long, that has been profitable and strong for so long, and has been able to invest in the platform, in the technologies, I think sometimes you don't realize it when you're not a part of it, particularly on a global basis. And we have some very large strategic clients that quite frankly, I think are, at the end of the day, really considering only 2 firms for certain types of work. And I think being on a platform that is one of those 2 firms affords all of our brokers and other services advantages because of the type of business that does filter down from the top.
I think you mean 3 firms.
No, I don't. I mean 2.
Just looking at the industry as a whole, going from 2 public companies to 4 public companies, 2 companies raising a lot of money, 3 so far, soon 4 maybe, raising a lot of money,
Right.
some of which they're going to invest maybe. Has competition increased among brokerage firms, and does it have anything to do with companies going public? Joanne, what's your take?
I think I just need to comment on the public company situation. Cushman & Wakefield, there's so much oversight because they're investors. And so it's not as if the transition to public, which everybody's been talking about the fact there'll be an IPO. I assume there will be. So the whole concept of being the transparency, the forecasting, all of the things that are required of a public company, we're already dealing with. And I hope and I believe that some of the things that Peter mentioned, we will be able to have even more of, which is that technology, that infrastructure, and the opportunity to continue to grow our platform with being part of a public company.
Let's talk about broker poaching. And I know Andrew said earlier he doesn't like the word, but we're still going to use it. So Cushman & Wakefield bought Massey Knakkel, hired Doug Harmon, Adam Speeds, this whole team. Newmark, before it went public, of course, brought on Dustin, among other people. Do you find that there's increasing pressure for brokerage firms to bring in top people? And what does that mean? Are you getting like crazier offers now? Are people offering you more money to switch? Are you noticing any change on that end? Whoever wants to answer that.
I guess it's a tremendous compliment for other companies to consider you and your services, and I take it seriously. And yes, I've had a great opportunity to look at some of these great companies as well. But the problem is, if you have infrastructure that works for you and you have the support system that you need, the move from one company to another can be quite traumatic. It takes a tremendous amount of time. And at the end of the day, oftentimes what you lose in time, and the startup again, negotiating the new contract, slowing down the process, accelerating the process to finish what you're doing, but really not beginning on new projects if you want to do things correctly. It can be expensive. It may not turn out to be exactly what you anticipate it to be, even with very generous offers. So unless you're unhappy where you are, it's tough to make that move, at least for brokers that are high-producing brokers.
And are you getting more of these kinds of offers from other companies?
I've been very lucky.
So when I got to JLL in 2002, Tri-State business was about a $12 or $15 million business. Last year we did slightly more than $500 million in the same area. And that business grew largely through acquiring businesses and talent. We've acquired brokerage talent, management talent, investment sales, debt talent from all of our competitors. And those people are performing on average, because we track it, at about 35% greater than they performed at their previous firms. And these are some very talented people when they came in. So they've seen the benefit of joining a national, robust platform. But they've also bought into another factor that the client obviously comes first, JLL comes second, and they come third. It's more of an investment banking style approach of sharing business, about working differently. And it's not for everybody, but the people that have come to our firm have definitely benefited financially.
I mean, I consider myself fortunate, right, to be doing what I'm doing and earning the living that I'm living. You know, it's sort of a dream for me being a kid from a small town in Ohio. So are companies offering good brokers significant sums of money? Of course, I don't think that's a secret. I I think Doug and Adam broke the barrier of sound, but for me moving, it was more than just about money. You know, like I mentioned, Peter and I were partners for 10 years. It was really a leap of faith for change and for new leadership responsibility. And it's been great. I would concur with Peter. My business at Newmark's probably 30% greater than my business at JLL. So it's a personal decision. It does take time to ramp up, but it can be a great thing. And I think we're all fortunate to be in a position, if you're a good broker, to be wanted by others.
When you say that Doug and Adam, I'm assuming you talk about Doug Harmon, Adam Spies,
Yes.
Going from East Hill Secure to Cushman and Wakefield.
Yeah.
When you say they broke the barrier, what does that mean? Did they just make it more acceptable to jump ship if you're a top producing broker?
I mean, it's been reported, but they were paid a significant sum of money. I'm not going to comment on how much, but they're very good at what they do. I think they're the best at what they do. And, you know, I think other brokers have benefited from these public companies having a significant war chest. I know Barry Gosselin, our CEO, spends pretty much every second of his time recruiting folks around the country and is on a plane. And I would expect that Newmark, as a public company with a ton of capital, is going to continue to grow and continue to strategically grow and hire intelligent, smart, aggressive brokers.
I think if you look at some of the deals, though, and the talent, it speaks for itself. They're the best talent in the business that move around. But some of the moves could be looked at maybe in more appropriate discussion, not in this room, but in an investment banking or financing discussion, because you bring in talent, you pay them X, but when you go public at a multiple, that really multiplies the value of the earnings to a higher degree, and it's a, you know, it isn't as an expensive acquisition. And so you don't see CBRE or JLL at those price ranges because they're already at a certain place, and it wasn't necessary to bring in talent to go public and get a multiplier. And I think when CBRE and JLL is looking at talent, I think it's more looking at talent maybe like the Boston Red Sox or the New York Yankees would, and saying, do I need a shortstop? Do I need a pitcher? Do I need a first baseman? And not, do I need a name to sell tickets? And I think that's kind of a little bit different approach.
Also, and using Doug and Adam as example, because they're really, we all know they're great guys, not only were they paid to come over to do investment sales, but I work with them now.
Right.
And so, and I'm quite sure others in the office as well, but so the effect is geometric, really. It's not just what you paid for them, but not only how much they'll do in terms of their own business, but how it affects other services in the office.
You mean they cross-sell leasing services, debt services, everything they can,
Exactly.
effectively, which they didn't have at East Hill because East Hill has neither of those. Actually, they have debt, but they don't have leasing or management.
Is there the risk, though, that firms just overpay for talent, that you say, we need to get this top broker, we're going to pay whatever it takes to get them, and then in the end, you know, it just doesn't pay out?
You know, the type of person that does this for a living usually has a motor that runs inside of them that you can count on, coming to work and work hard and competitive. And, you know, quite honestly, the talent we've brought in, we found that they've really, really worked really hard and almost wanted to prove that they were worth what they got.
So we haven't just seen IPOs, we've also seen a couple of mergers and acquisitions. Most recently, we reported, I don't know if it has closed yet, Newmark was in talks to acquire RKF. How far can this consolidation go? I mean, are we going to just end up with 4 or 5 big firms and then that's it? Or does the small to mid-sized local brokerage firm still have a future as a model?
Look, I'm only speaking, you know, personally, not on JLL public record, but I would imagine CBRE and JLL have another round of big acquisition in them, whether it's Cushman & Wakefield or Newmark or one of these firms, I mean, or Studley. I could see a day where there's more consolidation. It has to be in a spot, though, where there's not too much duplication, where there's natural fits. But I think the industry definitely has more consolidation in it. If you look at the demands and needs of clients on a global basis, even locally here in the city, some of the larger deals and complicated deals, I think it becomes harder and harder for smaller firms to compete.
Yeah, you're so right, Peter. I need the infrastructure at my company to do a good job. I don't consider myself of course I do leasing, that's how I make a living, but I spend most of my time doing the equivalent of consulting. We spend a huge amount of time understanding the client. I do retail leasing specifically, but understanding who the client is, what their needs are, what historically they've done in the past, what their long-term goals are. Those have really nothing to do with, I think you should be on 34th Street, as much as it has to do how you're going to grow your company. The information and the infrastructure that I need comes out of a big firm. It comes from a JLL or a CBRE or a Newmark. It has to be. And frankly, the global part of it is extremely important because so many of our companies, the publicly retailers, even if they don't want to go public, if they don't want to come here, they want to understand what other public companies in the U.S. are doing, and so they can learn from them. And so oftentimes, if you have those relationships, you can make those introductions. So again, the big companies are the most important way for us.
Go ahead. We see the firm, having this broad platform on a global basis and having stars, in New York, around the world, that aren't only doing brokerage deals, but are monitoring big clients, are introducing clients to other services that maybe they don't specialize in, but being a conduit to the organization and being compensated to do all those things.
And I agree. I think it's all about information flow, and the information flow because of technology and where that is today at a bigger firm is going to be more sophisticated and better, and it'll drive more revenue to you than a platform at a smaller firm, frankly.
Look, I'd like to come to work in a pair of jeans and have an office in the Village with a couple people and service some really good clients and do it that way, but it's just not going to work. It's just not going to happen that way.
All right, let's talk about the market for a bit. Since the subject of this panel is how do brokerages deal with a slowing market, we can debate to what extent the market is slowing or which part of the market is slowing. But Dustin, I want to start with you with a subject that everyone always talks about. So maybe we'll learn something new today. Rising interest rates, right? Last month, I think the US 10-year Treasury yields topped 3% for the first time in like 4 years. So it seems like this rise in interest rates that rise in long-term interest rates that everyone's been predicting is actually happening now. When you talk to your clients, when you talk to the developers who are out there in New York City looking for financing nowadays, are they worried about rising interest rates, and should they be worried about rising interest rates?
I think they're worried about rising interest rates, there's no doubt, but I haven't seen as much debt liquidity in the marketplace really since 2006. I mean, there's a tremendous capital flows into the space, more so than I've ever seen, and it's really driving transaction volume. I think if you look at Manhattan office investment sales volume, it's up from last year, which is down significantly from the prior year, so that's a good sign. But there's been an insertion this cycle of non-bank alternative lenders that are really the driving force behind that across all asset classes and financing types.
And so if rates continue to rise, are you basically saying that the interest rate spreads between, say, Treasury and mortgages are going to just shrink, or is debt actually going to get more expensive for developers?
If interest rates rise, right, there's a strong correlation to office rents as well, which means the economy is doing well. And so that's always been sort of the correlation that we sell. But borrowers are concerned. I mean, a lot of our business is structured finance, development-oriented, transitional loans, loans on empty buildings. And so borrowers are very concerned about capping their exposure to LIBOR. But interest rates relative to where they've been historically are still low. I mean, Peter probably remembers when interest rates were 10%. I don't, but he probably does.
So I would say this, having represented Bank of America, Skadden, BlackRock, and now recently Deutsche Bank, all looking for or considering creating a financeable event for ground-up development that, you know, the market's changed dramatically from deal to deal. And I don't know that the Skadden deal today could be financed. You know, they took a portion, you know, about 30-some-odd%, 35% of a 2 million square foot building. I don't know that that is as easily financeable today as it was a few years ago. You know, if Dustin was working with me still, I'd be in his office debating this with him. But I think that the market is definitely, you know, tightening that up. But the interest rate increases are really also helping the banks. They're making a lot of money. And they're starting to kick out and have more space needs. And in a place like New York, it has a dramatic impact on the marketplace. You look at JP Morgan Chase, you look at Bank of America, you know, their recent expansions and moving around in Midtown has had a definite impact on the market in a positive way for landlords.
Joanne, we're going to talk about the retail market in a minute, but first I just wanted to do a follow-up question about precisely that. So it's not just that banks actually get to stand to benefit from higher rates because they make more money on their spreads. It's also that we may be seeing more Wall Street deregulation coming out of Washington these days, right? Is that having an impact at all on leasing by financial companies? Are you seeing anything? Are banks more optimistic now than they were a year ago? Peter?
Yes. I think we're seeing a lot of strength with the US-based banks, financial institutions, and I think we're seeing a pullback from the foreign banks. I think the foreign banks are looking to dramatically decrease their footprints, move out of some businesses that they're not competing as well with the US banks. Even someone like Deutsche Bank, which is announcing a big move in Midtown, I think the footprint is going to be smaller than their footprint is today. And I think you're seeing that with other foreign banks as well.
So Joanne, the retail market arguably has bigger issues than rising interest rates. There's online retail. There's the, I don't want to call it vacancy epidemic, but vacancy epidemic in parts of Manhattan. What's the state of the market? I mean, how far do you think rents will have to fall in some of these prime corridors before the market can go up again?
So I actually believe that we've stabilized. And rents are down significantly, and it depends on the corridor. You know, you can't say define rents are down 25 or 30%. In fact, the downtown market rents are up for retail. There's not a lot of availability. It's a market with significant growth. It's the fourth largest CBD in the country. And so it is an important trading area for all kinds of commerce, including retail. And today, of course, with 60,000 residents, it's an important place for people to open retail stores. So it really is a divided story. Soho clearly has been affected. Their rents are down. We're beginning to see something of an upturn in interest and activity. And then you have to look at it from the perspective of what does it mean when a trading area or a street changes. Everybody talks about Bleecker Street, and I think this is the perfect example of the unfortunate perfect storm. As the market started to come down, meatpacking, which we all know, began to develop, and with Google, and a significant number of new retailers, whether it be Tesla or Samsung or Restoration Hardware, it's become an exciting and developing retail marketplace. Bleecker Street is 5 minutes walking distance. So those stores, you know, when it was a very sweet, quaint little street with Magnolia Bakery, it was perfectly fine. Retailers need density, they need foot traffic, they need to be a part of a community in order to really maximize sales. So you can see that shift. Corridors such as Madison Avenue, which were quite expensive, they've come down as well.
So does that mean we're going to see more of a gap between the rents you can get in these very prime, perfectly located areas as opposed to anywhere else in the city?
So residential markets, there was never really a reason why those rents should have run up so quickly because nothing changed there. there's not a significant change in the density, or there was nothing that made that market change dramatically. Hudson Yards, perfect example of the neighborhood along the corridor there is going to move quickly. Why not? You've got Hudson Yards, you've got critical mass. So it really depends on where you are.
Dustin, you obviously have a very different perspective on this. It's your job to finance some of these retail properties. What are you seeing? I mean, are investors and banks still willing to finance this?
I think it's overlooked often, but Soho, for example, which is where I live, I think a lot of the vacancy has more to do with the capital structure and when the building was purchased than is there tenants to take that space? Because
people overpaid for the building?
I think there is a clearing level generally for these stores. It's just a matter of what can the landlord afford to take. If they bought these units, these condos at the top of the market, like Bleecker Street, for example, and if the tenant can only pay $250 and they have to pay $500 in order for the landlord not to be entirely wiped out, they're just going to sit there and wait until the loan matures. And there will be a day of reckoning. It hasn't happened yet for the most part, but it is slowly starting to happen. We're seeing loan sale. Excuse me. We're seeing loan sale packages from major mezzanine loan holders on prime Soho properties, for example, that are for sale because there's an impending maturity and there's likely workout of some sort. So I think, again, it has as much to do with when the asset was purchased, what's the loan amount, the capital structure as it does to do with are there tenants to fill these spaces.
So do you think we're actually going to see like a wave of defaults in some of these areas?
I don't know if there's going to be a wave, but on a case-by-case basis, I mean, if you did your research, you could go through and sort of point out which deals have too much leverage. I mean, a lot of these buildings in the prime areas are owned by either long-term holders in the form of families, or they're owned by major institutions. So do they have the capital to buy themselves out of a problem? Maybe. It's going to be deal to deal.
Talk about the globalization of New York City real estate. It's been happening for many years. It still seems to be happening. You guys work with foreign tenants, foreign investors, foreign lenders. It's not just that the industry is getting more globalized, it also seems like it's getting more opaque, meaning you get investors from overseas that are some LLC, and you may not even know where the money is coming from. So I'd be curious to talk a bit about how you deal with that as an agent. As a broker, when you're dealing with an overseas entity where you may not be sure where the money is coming from, like, how has your own process changed of due diligence, of trying to figure out whether someone is a good person to work with, or whether you'd rather say, you know what, I'm not going to work with you because I just can't figure out who you are? And Joanne, if we want to start with you, I know there's...
Lucky me. So I think that you're alluding to China Sanangal and 23 Wall, which I had that agency for so many years, and through a series of representatives from China Sanangal, we could never get anything done. To their credit, they continued to pay the taxes.
If I can just jump in, I'll let you continue. Just China Sanangal, for those who don't know it, it's a kind of obscure natural resources investment company run by people from China, based in Angola, but maybe based in Singapore, but maybe also based in Hong Kong, that through various entities bought 23 Wall Street, the old JP Morgan building on Wall Street, and let it sit empty, and Joanne worked on that assignment. Anyway, continue.
That's okay. And it was frustrating because we did have opportunities. I had a Brooks Brothers deal. I had multiple deals. We couldn't conclude them because we couldn't get enough direction. The building now is in contract, and that's been challenged, but I believe that present contract vendee, I guess, is going to be able to buy it, and I hope he will.
So, it's New York City, right? It's an international city. I started in the business in 1982, and the Japanese were coming over, the Canadians, the British. We've seen the Chinese. We've seen, Middle Eastern countries. The competition here is so fierce for tenants to acquire the buildings, to run them at the right cost, to provide services. So you see a lot of foreign money, but they end up teaming up with very local operators who know what they're doing. So that's the first thing that I think is comforting is that there rarely is a foreign entity out there on their own doing it. We're representing one of them, Fosun, who's done very well with 28 Liberty, but that's usually an anomaly. It's not the consistent thing where you see a partner, you know, a foreign entity on their own. But also when you're representing a tenant or you're representing a landlord, you're always conscious of the capital stack, where the money's coming from, where things are, and it's sometimes harder to understand who the foreign money is in the deal. But again, I think it's a part of New York. It's always been here. Maybe the countries have changed, maybe the amounts have changed, but I don't think that's much different than it's been throughout my 35 or 6 years of doing
I
this.
think Peter's right. It's just, on occasion, you get an anomaly, you get someone who, or a company that comes in and you don't know who they are and what they're doing. But for the most part, people make a commitment to be here. They don't just buy one building. In the case of China Senegal, it's the only asset they have in the U.S.
I mean, all of our companies are global companies, so, you know, all of us have, you know, groups that are solely dedicated to connecting cross-border capital flows, whose jobs are to be in Korea or China or wherever it might be, somewhere in Europe, getting to know that investor base so they can bring those capital sources to New York or major market deals in the States. And so there are people at each of these individual firms who specialize in that. So there's typically not any sort of period of awkwardness with respect to some new entrant in the States.
Peter, apart from handling all sorts of office leasing deals, you also have a very interesting project on the far west side. 3 Hudson Boulevard, JLL was hired to, if it's been reported correctly, get a $3 billion equity and debt and all sorts of financing package for that ground-up office tower construction, which the Moynihan Group is doing. There's recently a deal announced that Boston Properties would invest $500 million in the project. As you're trying to raise money for that kind of project, you know, a huge office ground-up construction project in an area that already maybe has a lot of supply, where you need a ton of money for it, who are the people that are calling you about this? Who are the people that are actually in the market, willing, interested in taking on a project of that size?
Well, look, the Hudson Yards is, you know, one of the most successful developments in the history of our country. You know, certainly New York. It's proven already that it's a great location. It's attracted so many great tenants. 3 Hudson Boulevard is arguably as good or the best site for visibility, identity. It's on 34th Street, which is a wide thoroughfare. If you look at this city, you know, Park Avenue, Avenue of the Americas, wide thoroughfares, historically they do exceedingly well. It's got the train station in front of it. The Moynihan Group was brilliant, you know, Joe and his family, to acquire that site, you know, when they did. But the competition was fierce with, you know, developers that may have had a little bit more experience in developing, you know, institutional office buildings. And so, you know, nothing is signed, but, you know, it's been written, and it's expected that in the next couple of weeks that Boston Properties will join that partnership. And if that does happen, JLL will be, you know, leading the charge to lease it. And we, you know, have worked to put the deal together. And I think it's a very exciting deal for the marketplace because it brings one of the country's leading developers to Hudson Yards. And they can compete now for the next anchor tenant. You know, a partnership of the Moynihan Group and Boston Properties is going to be tough to beat. And it'll be exciting to see how that all plays out.
And aside from Boston Properties, what are some of the other investors types of investors that are looking at this? I mean, are you dealing with a lot of offshore money, a lot of foreign investors that would invest in this?
I think that there was a really a tremendous amount of interest in the site. But, you know, I think we were looking for somebody that was uniquely qualified to sort of be comfortable for an anchor tenant to say, build me a headquarters.
And so speaking of an anchor tenant, you, as was mentioned earlier, brought BlackRock to Hudson Yards. There's been a lot of asset management, private equity type companies moving to that area. Is that just sort of like the natural kind of anchor tenant for a building of that size, or who are you looking for?
For three? I think for three, there's going to be a lot of different tenants that could come. You know, the building could be bespoke to someone's particular needs. We're seeing some entertainment tenants, media tenants. We're seeing financial tenants. So it'll be interesting to see how it turns out.
And Dustin, you did, I believe it was late last year, an interesting loan deal. So 111 Murray, a ground-up condo development in Tribeca, is nearing completion, and you arranged for a massive refinancing. Basically, I believe it's like an condo inventory loan, or actually is a condo inventory loan, $650 million. We've seen a lot more of these types of loans lately, or at least we've reported more about them. Is that just a symptom of a slowing condo market, that people just don't sell their units and they just have to refinance?
For that particular deal, no. The existing construction loan was roughly $400 million. They had pre-sales of about $650 million, and we refinanced about a year before they were finished, basically at the proceeds amount of the condo pre-sales. The building is about 75% sold. So for that particular deal, there weren't any particular struggles. It was more of the sponsorship wanting to repatriate equity into other projects. But listen, I think the financing markets are extraordinarily liquid, and every deal that is coming out of construction in all asset classes prior to stabilization, including hotels, we're seeing a fairly deep bid from lending institutions to finance those, and to finance them without any cash flow. And I think that's the interesting trend that's keeping us really busy right now.
Let's jump back to leasing. So there's been some interesting proposals from City Hall. Bill de Blasio at some point, I think it was in a radio interview, he floated the idea of having a retail vacancy fee, where basically if you're a landlord and your retail property is empty, you pay a fee, and the idea behind it is you want to encourage landlords to fill spaces more quickly, because the more vacant retail you have, the more boring a street gets and everyone loses. There's also a proposal in front of City Council called the Small Business Job Survival Act, which would basically regulate lease renewals for office and retail, where if you're a small business, you want to renew your office lease, you would be guaranteed a minimum 10-year renewal. There would be a third-party arbiter, if I understand it correctly, that would sort of mediate if there's a dispute over how high the rent would be. So it seems like sounds like a big deal for both office and retail leasing, right? I mean, what sort of impact would that have?
Well, if it was legal, I think that's the first question. But the City Council is seriously considering it. I don't think there are two parts, just to respond to both. The vacancy tax is a little different. The vacancy tax suggests that landlords don't want to rent their space, which is kind of naive. And I think all of us should know that real estate taxes support 37% of the New York City budget. So, and I don't own any property, so I'm talking as a broker here. So I think real estate people spend a lot of money to build their buildings, to maintain them, to improve them, and to ask them to be burdened when they don't find the appropriate tenant to pay some kind of a charge is kind of nuts. And the second part is to guarantee a tenant, whether it be an office tenant or a retail tenant, that they have the right to another term, 10 years or whatever is determined to be. I think it's naive at best. I don't think that he's being ill toward, and these ideas are suggested in any way but in their belief that this is the right thing. But it's wrong on so many levels. Retailers, they evolve and grow over time, and they also slow down. They have all kinds of challenges. Maybe they're not part of the new economy. Maybe they don't understand e-commerce. Maybe it's a discussion in the family because Uncle Joe doesn't want to take over the business and his nephew is not interested. And there are so many reasons why these companies slow down or fail. But to give them an ultimate right to stay when a community may want a different kind of a tenant, or a community is looking to improve the neighborhood, or the landlord would like to, and to put it in the context of some kind of an arbitration for rent, I think it's really naive at best, but I think it's something we should all consider and look at seriously because it's the direction that the city government is going.
So somebody voted for him, right? He's the mayor. He won 2 elections. And I understand what he's trying to accomplish. When you walk around the city and you see vacant stores, you can envision if those stores were occupied, there'd be more jobs because people would be working in them. So there's somebody who's saying, well, this is a good idea because if we fill up the stores, it'll create jobs. And we'd like more local businesses, right? Because that creates more entrepreneurialism. So I get that too. But like most of the things that he doesn't surround himself with experienced professionals that can continue the thought process through. And what he's trying to do is really physically impossible. How can you tell someone that your store's vacant, you purchased it, you're struggling with it, and to make matters worse, we're going to charge you a tax.
And by the way, you're still paying taxes on the property, even if it's
Right,
vacant.
you're already paying taxes on the
additional
property.
tax.
You know, there are a lot of ways to create jobs and fill up those stores, right? And I'm not going to debate them today. It's for people that are much smarter than me in that. But taxing vacant stores is certainly not one of them.
All right, so I think Peter was basically saying Bill de Blasio should hire him as an advisor, if I understood you correctly. With that, I think we're out of time. If we have enough time for a couple of questions from the audience. If anyone wants to chime in, ask a quick question, time for 2 or 3. Otherwise, I'll keep asking. Yes, please.
Hello. Do you see, since the Brexit dust settled, do you see more institutional and foreign capital flowing into European market, London, Berlin? I guess that's a question for everyone.
So, again, we have a big business in Europe and in London. And to be perfectly honest with you, despite the media hyperbole in the United States, most of the smart people in London are saying Brexit over the next few years will be better for the British economy and better for the real estate business. They're already seeing the advantages of it, and I don't think it's going to have an effect positive on any other place, including European cities, over the next 3 or 4 years, because it's ultimately going to be better for England and London.
All right, any other questions? Please, right in the front. Just wait 1 sec, we'll come with the mic. You want everyone to
Talk about Midtown East rezoning. Does the community there have any discrepancies with what the real estate board wants to do?
The question is about Midtown East rezoning, and could you repeat it, please?
Is there any discrepancy between the community boards of Midtown East?
I think it was Midtown East and the redevelopment with One Vanderbilt.
Yes.
So I think it's been pretty much.
So the rezoning obviously has already played a huge effect with J.P. Morgan Chase, right? I mean, their reimagination of their headquarters in a large part has to do with the rezoning and the ability to make that site bigger. I think there's already a tremendous amount of prospecting going on along the east side in buildings where large tenants are rolling over, and can those buildings be repositioned for a higher development, or some residential buildings that are sitting amongst commercial areas, can they be better suited and redeveloped with the zoning? And it'll be interesting to see how this plays out over the next decade or so. What's that?
I'm sorry, come again?
I think
It's already
pretty
done.
much resolution unless there's something new.
Yeah.
It took quite a while, but I think it's all been approved. And by the way, it's a positive for even retail and for refi. And I mean, you're redeveloping a core part of the city with the most important transportation we have.
Agreed.
And so
I
it
think
would be a shame not to.
What was the average age of office buildings in Midtown around Grand Central?
Oh, I mean, if you take the numerator, I used to say buildings built in 1980 and forward, do it 1990, 2000, whatever you want to do, and the denominator being the total space in the marketplace, New York City is the oldest office stock anywhere, certainly in the United States. And so any opportunity we have to add new product is very, very important. There were people that were critical of giving zoning bonuses to the Hudson Yards, right? And look at the success and the new vibrant part of the city that we currently have there.
Yeah, I think Marty Berger during the earlier panel was saying that 7% of Manhattan's office space was built in the last 20 years compared to like 80% in Hong Kong, which is...
And by the way, the retail at the bottom of these office buildings is horrible, and it will, as it improves efficiencies, costs, and opportunity.
All right, I think we're out of time. Please give a round of applause to the panelists, and thanks again for joining us.